Hi, this is Ross Healy, Chairman of Strategic Analysis Corporation and a Portfolio Manager with McNichol and Associates Asset Management. Welcome back to FANG Friday. Anyway, last week we were looking at Netflix, and what we observed was Netflix breaking down as we actually expected. We've had a kind of a sellout, as it were, on Netflix. We have not liked the stock all the way through from the beginning of this FANG Friday series. And see, it fell here, went back and sort of retested a breakdown and then a check back. Did exactly the same thing here, and we were looking for a breakdown and a possible checkback. Today, however, the numbers are pretty savage on the downside, and it looks as if the stock is going to keep on going. What I want to do is put it into a kind of a larger context here, and in doing so, what I wanted to do was show you how the stock looks like from a longer term perspective. And what you see here is from the peak, the stock went 1, 2, 3 breakpoints down before rallying. And then it was unable to break through the HB5 valuation level shown here. And now we have a 1 and a 2. And the question is, are we going to get a 3 breakdown? And I think the stock is already doing that. Have we seen this kind of action before? Yes, we have, and it's what we call a walking down stairs kind of pattern, and which is quite instructive, by the way. I went back to look at Coca-Cola, which is the first time I actually really noticed this phenomenon. And here was Coca-Cola. This was way back in 1998. Look at the stock peaked here at its HB5. That was about 25 times book value. Dropped 2 breakpoints, rallied a breakpoint, dropped 2 breakpoints, rallied a breakpoint, waited, dropped 2 breakpoints, rallied, and then dropped 2 breakpoints. Didn't quite make it up to the HB1 on the last rally, but it did in the next move down. It did actually fall to those 2 breakpoints, and more importantly, it fell to its fair market value. Well, just remember from looking at Netflix, the fair market value here is down 67%. In the Coca-Cola example, the stock fell from a high of about 40 to about 18, 19, so about 50%. Now, observe that it took about 5 years, so I don't know whether it will take this long to unwind the Netflix saga, but what I'm telling you is that there is good precedent for that to happen, and Netflix looks to be following a sort of an adaptation, if you like, of the Coca-Cola story. Well, here is our friend NVIDIA, and remember last week, actually the last couple of weeks, I noticed that that the stock had kind of rebounded back up to its HB1, and it actually broke out. And I said, look, I wonder if this is a head fake, the way we had here, because it had fallen. It broke out, and we thought, okay, we better put it in the portfolio if it's broken out, because that's the SVA discipline. Well, it failed, and well, God bless me, it has tried again. Today, thanks very much to the Micron Technology numbers, the stock is way down. And of course, the other thing that is way down is that Bitcoin looks as if it's falling out of bed again. Well, NVIDIA is almost a proxy for Bitcoin, and it looks as if it's going to be falling. And in any case, the fundamentals of the industry are very questionable as well. Let's go and take another look at Amazon. As you know, we've really excluded that now from our FANG portfolio for some time after it broke down through its HB3 valuation level and that break point. For a long time, the stock just kind of hung in there, but it now looks as if it's beginning to accelerate away on the downside. And that I think we are going to see a decline to its HB2. That's just shy of $1,500. So if I were an investor, I think that Amazon has given us lots of warning that it wants to go there, and I would avoid this stock. Facebook, well, we had kind of hung manfully in to Facebook, even when it did some funny little things here, like this quick little dip here, because it seemed to be riding its mid-super growth price. That's 5.5 times book value. Um, Despite all kinds of little things that had come up, the stock managed to hang on manfully at the MSG price, but it is now let go. I don't think it's this kind of a let go. I think it's more a kind of a this kind of a let go. And I think that we are going to be looking at lower prices ahead. I would still like to buy, and in fact, I would prefer to buy at its super growth price. That is a very, very critical and powerful support level, which is down at 118. But we'll see. We'll see what happens at the LSG if it's able to give a decent bounce right there. Here's Alphabet. Well, here's the very, very long-term view. In fact, the 10-year view of Alphabet. And Alphabet is just riding a lovely upwards channel. It's riding, I think, at a rate of about 18% annually, something like that. When we started FANG Friday, the stock was up at the peak of its LSG channel. That is 4.5 times book value, and we have been waiting for the stock to at least fall to its super growth level, which is 3.5 times book and a very, very important breakpoint value. So we have actually not been in that, and we haven't really missed anything, although I suppose it would have been lovely to have caught that rebound. But from the time that we started the FANG Friday portfolio, in point of fact, the stock is down from, and we are not going to put it into the FANG Friday portfolio. Here's Apple, and well, you know, there it is. It's trading a little bit above its fair market value. It's trading between two breakpoints. What do we want to say about it? Well, I'll tell you what we want to say about it. We want to take a look at the 10-year view of this company, and what we see here is that the stock has tended strongly to peak out at its fair market value. And that's exactly where it is now. Notice the last time that it got there, it had quite a drop. So this is not the time, in our view, to be getting into Apple anymore. I think it's time to avoid having anything to do with the stock because, first of all, of course, their previous 2 quarters were pretty poor, and you can see that in the slope of the earnings, which is essentially earnings forecast, which is the fair market value. So we are very, very leery of this stock. Finally, although it's not a FANG stock, of course, nonetheless, we have been talking about Microsoft for some time, not the least of which because it's got a market cap of over $1 trillion. So it is probably a stock that we ought to be commenting upon, whether it's a FANG or not. And here, of course, the company had run headlong up against its HB1 breakpoint. That's about 10 times, roughly about 10 times its book value. It has had a very, very difficult time. Well, in fact, it hasn't been higher than this level for a very, very long time. And of course, the fair market value is 36% lower than where the stock is today. In the past, I have shown you the relationship of the stock to its intrinsic value, which is the dotted line here. And as the intrinsic value fell away, so did the stock valuation. Well, I reminded people this was the Windows 7 upgrade, and it was a big seller. And the earnings went right back up with it, and so did the stock, carrying it all the way back to its HB1. Well, again, here's the Windows 10 update, and not so popular. Look at that, eh? It's been unable to really catch the same amount of fire as it did the last time. Well, okay, what are they going to do about it? Well, what they're going to do about it is that they're going to buy back, they say, some $40 billion worth of stock. Well, is that a lot of stock? Well, let's take a look at the market cap. We've got a $1 trillion market cap, and they're going to buy back $40 billion. Well, isn't that 1% of that billion-dollar market cap? Yes, that's a lot of money, a lot of walking around money for you and I, but for a company with $1 trillion market cap, in point of fact, the impact is not nearly as great as it sounds in dollar terms. So, yes, we're impressed by anybody who blows $40 million in buying a horribly overpriced stock back. Talk about a stupid waste of resources. But nonetheless, in terms of the impact on the company, its fair market value, I don't think is going to be all that profound. And is the stock going to break out and run further? Right now, I don't see it. Anyway, this has been the Friday, the September 27th edition of FANG Friday. When we go and look at the portfolio of FANGs, we actually don't find anything in there, do we? We never got a chance to buy NVIDIA because we thought it was a head fake. It has been a head fake. Amazon is out and looks as if it's heading lower. Facebook, which we had manfully hung on to, also appears to have rendered a sell. And of course, we have not liked Netflix all the way along. Google, perhaps, you know, if you were desperate to hang on to something there, perhaps Google is the safest one. It's the only one which actually hasn't either rendered an outright sell signal or is at such an extremely high valuation level as, for instance, Apple, that we would be really nervous about buying it or holding it in our portfolio. Anyway, this has been Ross Healy, the chairman of Strategic Analysis Corporation and a portfolio manager at McNichol & Associates Asset Management, reminding you that nothing, including investing, is difficult if you have the right tools. I'll see you next week.